Ever thought about becoming a millionaire? I know, it sounds like a total fantasy, right? Well, what if I told you it was actually pretty straightforward? In this explainer, we're going to break down exactly how to do it step by step using a super simple strategy called index fund investing.
Let's just put it out there. The big number. The one that gets everyone's attention. $1 million. It just feels impossible, doesn't it? Kind of like something that only happens to lottery winners or, big shot CEOs. But what if you could get there from just $200 a month? No, seriously. That's the incredible power of the strategy we're about to unpack. See, it's not about being rich to begin with. It's all about having a simple, consistent plan. Okay, so if it's that simple, why isn't everyone a millionaire? That's a fair question. And the answer is what I like to call the $1 million lie. The truth is, most of us have been fed a bunch of stuff about investing that is just flat out wrong. And this quote, man, it just hits the nail on the head. It taps into that feeling we all have sometimes, right? That the game is rigged, that you're already starting way behind. For years, the whole world of investing has been deliberately made to feel super exclusive and complicated. But guess what? That whole story only helps a tiny group of people, and it's not you. And these right here, these are the lies. These are the myths that paralyze people and keep them from even starting. Just look at them. How many sound familiar to you? Oh, investing? That's just for rich people. Or you gotta be some kind of Wall Street genius. And my favorite, it's way too risky. You'll lose all your money. Well, guess what? We're about to pop every single one of these bubbles.
And here's the real kicker, the dark truth. You know those experts, the pros in suits who charge you a ton of money to manage your investments? Well, get this. On average, they actually underperform the market by about 2% a year. So let me get this straight. You pay them high fees for them to do worse than a simple automated strategy? It makes no sense. Why would anyone pay more for less?
All right, so we've pulled back the curtain. We've exposed the lies. Now it's time to actually understand the game. And trust me, once you learn the language, and it's way simpler than you think, all that fear just starts to melt away. So what's this magic bullet I'm talking about? It's called an index fund, and it's so simple. Instead of trying to be a genius and pick the one stock that's going to take off, an index fund lets you buy a tiny piece of all the top companies at once, like the 500 biggest companies in the US, all in a single click. It's like buying the entire haystack instead of looking for the needle. I love this analogy. Think of the S&P 500 as the ultimate sports league, the absolute big leagues of American business. You've got your star players at the top, your Apples, your Microsofts, and here's the cool part. If a team starts to suck, they get relegated, they're kicked out of the league, and a new up-and-coming team takes their place. So when you buy an S&P 500 index fund, you're not just betting on one team to win the championship, you're betting on the success of the entire league, year after year. It's brilliant. And the proof is in the pudding. I mean, the numbers don't lie. Look at this. Over the last 10 years, the S&P 500 index averaged a 13.6% return. Remember those experts we talked about? They were about 2% less than that. So you're literally getting better results with a simpler, cheaper strategy. It's a no-brainer. Okay, everybody who's worried about risk, listen up. This might be the most important thing you hear today. Let me say this slowly so it sinks in. In the entire history of the S&P 500, no one has ever lost money if they invested and just held on for 20 years or more. Not one person, ever. Yeah, the market has its crazy ups and downs for sure, but over the long haul, the trend is always, always up.
All right, you feeling better? A little more confident? Good. Because now we're going to get practical. Let's build your investing toolkit. These are the actual tools and concepts you need to know to make this whole thing happen.
First up, your secret weapon. This is your superpower, okay? They're called tax-advantaged accounts. Think of a Roth IRA in the US or an ISA in the UK. These special accounts act like Captain America's shield, literally protecting all your investment profits from being devoured by taxes. This is a huge deal. You get to keep so much more of your own money. Okay, quick clarification. You're going to hear two terms thrown around: index funds and ETFs. Don't get bogged down. They're basically cousins. They both let you buy that big basket of stocks. The main difference is just some technical stuff about how they're traded. Here's all you really need to know as a beginner. ETFs often have a super low minimum investment, sometimes just the price of one share. That makes them an absolutely fantastic and easy way to get your foot in the door. And now for the real magic, the eighth wonder of the world, the snowball effect of compounding. At first, it's like you're just packing a tiny snowball at the top of a hill. It's slow going, but as you roll it, it picks up more snow, and then the bigger it gets, the faster it grows. After a few decades, that snowball is an avalanche. You get to a point where the money your money is earning is way more than the money you're actually putting in. It's incredible, and it means time, not timing the market, is your greatest superpower. Okay, deep breath. We've covered the why this works, and the what tools you need. Now for the final and most important piece of the puzzle, the how. This is it, your concrete, no-fluff action plan to actually make this happen.
And I promise you, it really is this simple. 3 steps. 1. Set your goal. Seriously, just go online, find a compound interest calculator, and play around with the numbers. It's actually fun. 2. Pick a brokerage. That's just the company that lets you buy the investments. And 3. Choose your funds and, this is key, set up automatic monthly investments. Set it and forget it. That's the whole plan.
Feeling overwhelmed by which brokerage to pick? Don't be. Just start with one of the big 3, Vanguard, Fidelity, or Charles Schwab. They're all huge, they're all trusted, and they're all low cost. Vanguard's kind of special because its founder basically invented the whole idea of index fund investing for regular people. Honestly, you can't go wrong with any of them. Okay, the final question. What do I actually buy? Here's a super simple, super effective sample plan. You put about 70% into US stocks, like an S&P 500 fund, then maybe 20% in international stocks, so you're not just betting on one country, and finally 10% in bonds. So what are bonds? Just think of them as the shock absorbers on your car. They're safer, and they help smooth out the ride when the stock market gets bumpy. It's a really nice, balanced approach for the long haul.
So let's bring it all home. We've seen that building real, life-changing wealth doesn't take a massive paycheck or some secret Wall Street handshake. The single most important ingredient is time, and you can't get more of it. The sooner you start that snowball rolling, the bigger it's going to get. It's that simple. So the only question left is, when are you going to start?